Chapter 8.3 Journal Entries. In this chapter, you will be able to understand records to be maintained for tax calculation, documentation or accounting needs, and how to pass journal entries. Output tax and input tax. Output tax arises on sales as well as on rendering services, and input tax arises on purchase of goods as well as on procurement of various services. So there is an output tax and an input tax. The tax arithmetic to calculate liability of tax payable is output tax minus input tax. That means the tax liability is calculated by using the formula output tax minus input tax. Tax applicability. There is a requirement of record keeping or accounting needs under the law for calculation of tax, and we can find that there is a tax on the seller or service provider, the buyer or service recipient, that is under reverse charge, tax on agents acting for principal, tax on agents acting on their own, zero tax or exempted transactions within designated zones, tax on electronic communication transactions, tax on domestic transport of goods, tax on capital goods, tax based on profit margin or under compounding scheme, tax on deemed sale or services or supplies. So in these all scenarios, you can see the calculation of tax. Documentation or accounting needs. There are various multifarious products or services as well as various transactions based on which we have to maintain documents or accounts. There can be taxable transactions where liability is on a normal levy or on reverse charge basis. There can be zero rated transactions. There can be VAT exempted transactions as well as taxable or non-exempted transactions. Again, sales or services to designated zones, vendor-wise or customer-wise transactions, purchase and sales transactions. All these transactions should be supported by the documents as well as the accounts in the business scenario. Then again, we have to do the matching of transactions for availing input tax credit. Again, cross-check or self-audit mechanism as required by law should be done to ensure for calculating the correct tax liability and payment of such tax. So the documentation or accounting needs is based on customer or vendor wise, product or service, quantity or volume, price, nature of tax, taxable value, tax amount, tax registration number of both supplier and customer, type of exemption if any, type of levy, HSN product or service code, capital goods tax if any, etc. Let us take an example here. X and company procured the product from Y and company for 80,000 dirhams, on which 5% tax is also paid. That comes to 4,000. And X and company has sold product for 1 lakh dirhams, on which 5% VAT is applicable, and the tax on transaction is 5,000. Solution. So in this case we can see the tax payable by X and company is 5,000 minus 4,000, that is 1,000 dirhams, because tax payable is output tax minus input tax. This is output tax payable, and accounting entries will be as under. Books of X and company. For sale transaction, we have to pass the entry like this: customer account debit 1,05,000 dirhams, to sales account 1 lakh dirhams, to VAT output tax account 5,000 dirhams. Then for purchase transaction, we have to pass the entry like this: purchase account debit 80,000 dirhams, VAT input tax account 4,000 dirhams, to vendor account 84,000. Books of X and company. At the end of the cutoff period, the following entry is passed, offsetting the input tax credit against the output tax payable. The entry will be like this: VAT output tax account debit 4,000 dirhams to VAT input tax account 4,000 dirhams. The VAT output tax account ledger will read only the payable balance of 1,000 dirhams now, and that will be cleared with the payment done as prescribed by the law. Write-off of bad debts. Writing off bad debts is also covered in the law under Article 64. A cutoff of 6 months is given to write off if there is any non-recoverable bad debts. And it is to be noted that there should be a communication to the recipient regarding such write-off. For writing off of bad debts, it warrants immaculate record maintenance. Penalty for non-maintenance. Absence of record will mean the tax authority can deny the input tax credit, or the authority can levy additional tax on the output transaction, or the authority can impose penal consequences also. So the record maintenance is of utmost importance as per the UAE VAT law. While it may appear difficult on the outset, with the help of ERPs and computer database software, it is not an impossible task to maintain records accurately as well as systematically. So that is the end of the chapter 8.3 journal entries. Thank you.